I'm going to talk to you about how the FX market worked, what the fixes were and how they were set, and how traders attempted to manipulate the FX fixes. These slides need to be viewed in context. We have imposed penalties on these firms for systems and controls failures. Those failures made the misconduct by traders possible. As you can see on this slide, the FX market is absolutely massive. The daily average volume turnover of the global FX market was over $5 trillion in April 2013, according to the Bank for International Settlements 2013 survey. And to put this in perspective, you can see on the right how the size of this market compares with a few other key markets on a daily basis. The global bond market, $272 billion, the global equities market, $216 billion, and the New York Stock Exchange, $49 billion. The word fix is market speak for an FX benchmark. In these cases, we are talking about two of the most widely referenced fixes, the 4 p.m. WM Reuters fix, or WMR, and the 1:15 p.m. ECB fix, which are fixed in two different ways. WMR fixes happen throughout the day, but the most widely used is the 4 p.m. fix. The 4 p.m. WMR fix is calculated by reference to trading activity during a 1-minute window or fix period, 30 seconds before and 30 seconds after 4 p.m. The 4 p.m. WMR fix rates are then published shortly thereafter. This diagram gives a hypothetical example of what the WMR fix might look like, where the purple shaded area represents the 1-minute fix period and the blue line represents the trading. The ECB fix is different because it is a snapshot of the market at a moment in time, which is 1:15 p.m, and this is what the diagram shows, that instead of having a fixed period, we have a single point in time. Why do people want to trade at the fixed price? The Financial Stability Board's September 2014 report on FX benchmarks said that asset and other money managers want to ensure that their FX trades are executed at the same price as the fix. That eliminates any tracking error. Prior to a fix, clients often place orders with a firm to buy or sell at a specified volume of a currency pair at the fixed rate. Obviously, at that time, the future fixed rate is unknown. By agreeing to transact with clients at a fixed rate that is yet to be determined, the firm is exposed to rate movements at the fix. So as you can see here, the risk passes to the firm. A firm will typically buy or sell currency in order to manage this risk, for example by trading in the market or netting off, for example where a firm has a buying interest for the fix and trades with a market participant which has a selling interest. So in this example, the client wants to buy a currency pair and the firm is agreeing to sell that quantity of the currency pair to the client at the fixed rate. What this means in practice is that the firm with this buy order will make a profit if the average rate at which it buys the currency in the market is lower than the fixed rate at which it sells to its clients. There is nothing wrong with a firm which is legitimately managing its risk making a profit through trading at the fix. One of the issues in this case is lack of control over the chat rooms used by traders. Many firms have now imposed restrictions or outright bans on the use of chat rooms in certain circumstances. Traders use chat rooms to share information about the fix orders, to determine their trading strategies, and to attempt to manipulate the fix. This slide gives you a flavour of what these chats were like. Have a look at the blue boxes, which are some of the names the traders used to describe themselves: the players, A team, One team, and the Three Musketeers. Then look at the yellow boxes and how the members of the chat rooms described how they operated. A three-way relationship built on immense trust. Don't want other numpties in the market to know, but not only that, is he going to protect us like we protect each other? How can I make free money with no heads up? Cheers for saying you were same way, helped me go early. I'd prefer we join forces. Perfect, let's do this, let's double team 'em. Each of the final notices has a worked trading example in it of behaviour around the fix, which was able to happen because of the firm's inadequate controls over its G10 Spot FX voice trading business. We have prepared some slides which demonstrate this visually, using the material from the notices, which we think helps make it clearer what was going on. An example of Citi's involvement occurred on one day within the relevant period, when Citi attempted to manipulate the ECB fix in the euro-dollar currency pair. On this day, Citi had net client buy orders at the fix, which meant that it would benefit if it was able to move the ECB fix rate upwards. Remember that the ECB fix is set based on trading at a moment in time. Because Citi is a buyer, it will benefit if it can move the fix rate up. Let's look at what the traders were saying to each other ahead of the fix. Citi has net buy orders for the fix of 200 million euros. Firm A has net sell orders for the fix of 47 million euros. Firm B offers to transfer its net buy orders for 26 million euros to Citi. Citi agrees. This increased or built the volume that Citi needed to buy at the fix by this amount. This is an example of giving you the ammo, or building. Building effectively increases the volume of orders held by the traders in the chat room in the desired direction. The more you have to trade, the greater your potential influence on the fix. Firm A tells Citi that it has netted off its sell orders with another counterparty. You should be nice and clear to mangle. This is an example of leaving you with the ammo. We read the word mangle in this context as trader speak for attempt to manipulate the fix. It's worth explaining what leaving you with the ammo means. Traders in a chat room with net orders in the opposite direction to the desired movement at the fix sought before the fix to transact or net off their orders with third parties outside the chat room rather than with other traders in the chat room. This maintained the volume of orders in the desired direction held by traders in the chat room and avoided orders being transacted in the opposite direction at the fix. Firm C has net sell orders for the fix of 39 million euros and offers to shift it, that is, to trade with the order with a third party outside the chat room. Firm C reports that it has matched on fix here, you're all clear. This means that Firm C has netted off its sell orders with a third party and that Citi is clear to trade at the fix without Firm C's orders being traded in the opposite direction. This is an example of leaving you with the ammo. Firm D needs to buy an unspecified quantity of euros in the market at the ECB fix. Firm D offers to transfer these net buy orders to Citi or execute this order in a way that would assist Citi. You can have or I can help. Firm D transfers its net orders of 49 million euros to Citi. This is another example of giving you the ammo or building. The effect of this was to increase the influence that the traders had with regard to the fix, and therefore the likelihood of them being able to manipulate the rate in the desired direction. Remember, because Citi is a buyer, it will benefit if it can move the fix rate up. The chances of success would be improved if Citi and the other firms shared information. Since Citi needed to buy euros at the fix, it would profit to the extent that the fix rate at which it sold euros was higher than the average rate at which it bought euros in the market. This graph is a hypothetical example demonstrating this. The blue line shows where the market is trading, the green dots show Citi's trades, the green dotted line shows Citi's average price, and the dotted purple line is the fixed price. The gap between the fixed price and Citi's average price represents Citi's profit. Citi has buy orders from clients of 83 million euros. In the period leading up to the fix, Citi increased or built the volume of euro that it would buy for the fix by trading with firm B and D and by a series of similar trades conducted with other market participants. This trading increased the volume of currency that Citi would seek to buy for the fix to 542 million euros, well above that necessary for risk management. Remember, the more you have to trade, the greater your potential influence on the fix. In the 15 seconds before the fix, Citi placed 4 buy orders of increasing size and price, and which were priced at a level above the prevailing offer price, that is, seeking to buy at prices which are higher than where sellers are offering to sell. This slide operates in real time, so let's see what happened in those 15 seconds. "15 seconds before the fix, Citi placed an order to buy 25 million euros. You can see this is just above the prevailing offer by 1/10 of a basis point, which is shown by the red line. 11 seconds before the fix, Citi placed an order to buy 50 million euros. Again, this is above the prevailing offer by 4/10 of a basis point this time. 6 seconds before the fix, Citi placed an order to buy 100 million euros, 1 basis point above the prevailing offer. And 3 seconds before the fix, Citi placed an order to buy 400 million euros at a rate that was 1.5 basis points above the prevailing offer. As you can see from the graph, after each order, the trading price moves up. At 1:15, the bid or buying price and the first trade for euro-dollar on the EBS platform was 1.3222. The ECB subsequently published the fix rate for euro-dollar at 1.3222. Remember, Citi's last order 3 seconds before the fix was at the price of 1.3222. During a 33-second period around the fix, Citi bought 374 million euros, which accounted for 73% of all purchases on the EBS platform. This is obviously huge by comparison with what everyone else on the platform was doing, as you can see here. Let's see what they have to say after the fix. Impressive. Lovely. Yeah, worked okay, says Citi. Can't teach that. 22 the rate. Always was gonna be, says Citi. Citi's trading in euro-dollar in this example generated a profit of $99,000.